we are officially live on Facebook because we are kicking off the Not Your Average Investor Show. A little rocky beginning, but I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, because he doesn't like it when I go to Cleveland, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
And with us, as always, hanging out in the chat, making sure that you get whatever you need, our magnificent community manager, Madison the Magnificent. Say hello, Madison.
Hello, everybody.
We already see the attendees kicking up. If you are listening to us on the podcast and you haven't felt the in IRL experience of being on the Zoom call, if you've been on YouTube and you don't get this sense of like community when you're hanging out watching this all by yourself, you want some company while you watch the show, go to nyais.com, register, put it on your calendar, just show up whenever you get a minute, because these Not Your Average Market Insights, people are loving them, and you get to be part of what, GC?
The roll call, baby.
The roll call. All right, let's go. We got Madison welcoming everybody in the chat to the Not Your Average Investor Show. We got our leadoff hitter, John Henning, saying good afternoon, all. We got Danny Davis checking in from Germany with a Guten Tag. We got Lee Bishop, the MVP of the Not Your Average Investor Show community, saying glad to be here. We got Dean Curry, upcoming guest investor on Thursday. We're going to hear from him a bunch. Checking in. We got Miguel Ángel Sanudo, our hermano from Andalusia, checking in with us in Spain. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill, checking in. We got the guy that everybody knows as Noah Randari, saying hello, everybody. Hello, Noah. Good to have you. We got Vivian Brick. She's back from beautiful Santa Monica, California. We got the matriarch of the first family of the Not Your Average Investor Show, checking in, Carolyn Moline, assuming she is with the patriarch, Ken Moline. We salute you.
We salute.
We got our regular Rosalind Riley from Murrieta, California, checking in. We got Eddie Harris from Hotlanta. He's back. Good to have you, Eddie. We got Leo Faraganan. Faraganan. He is in Manila, Philippines, man. So it is midnight over there. It's 12:30 a.m. So we appreciate the dedication, Leo. Good to have you. Let's rock with you. We got Mark McDermott from the Great Lake State of Michigan.
All right. Is that a new name? New name alert?
New name?
New name.
Mark, happy to have you with us. Hope you make a habit out of joining us. We love if you contribute here as much as you want, get your questions answered. We got Barbara Mershon from Colorado. New name?
Well, I know Barbara very well. She is a longtime client and somebody that we have just loved having as a client for so many years. So happy to see you here, Barbara.
Love that.
She might be a new name for you.
Maybe a new name for me. Barbara, happy to have you. I'd love to know. Let us know in the chat. What made you show up? Longtime client, first time listener. I'd love to hear what made you come to this thing. Medj Garcia, who we know and love very well. Welcome back, Medj. Great to see you whenever we get the chance. Kurt Stein checking in on Facebook.
All
Kurt
right.
Stein, yeah.
Hey,
The co-founder of the Spikeball crew.
That's right.
Popular guy. Misty Johnson from Colorado. Misty, good to have you back on the show. Past guest investor and star. Leonard Lee. What's his name?
He is the Iron Man.
the Iron Man of the IRL meetups, the best attendance of IRL meetups. We got Hervé in the house. Hope everyone's staying cool out here from Jersey. Hervé Francois checking in. Don't pronounce the H's around Hervé. He takes it very, very seriously. We got Joshua Wedding. Pumped to be here from Longview, Texas. New name.
New name?
New name.
I think that's a new name.
Good to have you, Joshua. We got Aaron O'Neill checking in. Aaron, the ex-lurker, now full contributor. We love to say your name, Aaron. I love the fact that ever since we met in public, now you're all in on the chat. Raj Bantu, who's a regular here. Love Raj. Camille Jameson from Jameson Financials. Camille, good to have you. We got Saren Jennings from New Jersey. She's back. Chris Gonzaga from the illustrious Hudson Valley of New York. We got a full house, GC. What do you think?
I see one special person who's lurking right there too, by the way. I just want to mention one lurker out there. It happens to be my mom. I see her lurking over there. Debbie Alo. If you guys want to send some love to mom over there, she's lurking. Go ahead and hit her up in the chat. Love you, mom. Thanks for being here.
All right. Love you, moms. Shout out from GC. We got Dr. Meadows from St. Simons. That's St. Simons Island, I would assume.
Yeah. And Dr. Meadows, he's a name we know well here over JWB, a private lender of ours for many years. And yeah, just wonderful to see some some longtime friends here.
That is good news, man. And other good news, your mom loves you back. She says so it's reciprocated. All right, let's get into it. We got about 50 people with us today. So already the Not Your Average Insights, it is a crowd favorite. It is a host favorite. GC and I love doing this stuff. And I think we just kick off with the question on everybody's mind. What we kind of like held off for a while. We've been dying to get into this, GC. There is all these headlines and all these ruminations about how corporations and Wall Street investors are buying up Florida property and are buying up Jacksonville homes at a record level, right? Like it is a higher percentage of the mix than it has ever been. And people want to know if it's good or bad, man. What do you first of all, tell us the numbers. I know that you've been diving deep on this. Yeah. And I'd love to get your perspective on this, man.
And I first just want to recognize Michael Santorios, who's a longtime client of JWB and an avid listener of the show. Michael sent this question in to us. She's probably 2 weeks ago and said, hey, I'd love for you guys to do a show specifically on this. So as we delve more into the Not Your Average Insights, this is a perfect opportunity for us to be able to receive feedback or ideas from you and bring it to you. And I get to do a little bit of research. Pablo and I get to hash it out a little bit and come up with something that hopefully adds a lot of value to you. So thank you so much, Michael. So here's what Michael pointed out in the email he sent to me. He said, listen, according to Redfin, the percentage of homes that are purchased by investors has gone up super high. Should I be concerned that if the market should take a turn, that these investors who are buying based on returns on investment, all of a sudden would say, hey, this isn't worth it for me, and then dump their properties? And could this crash the market? Right? Maybe that's a question that you all are thinking out there. So I first wanted to dive into the data, and then I'll give you my thoughts on it. So I looked at the Redfin report that Michael sent over. Here's some of the data coming from that report. 20% of the purchases in the first quarter of 2022 across the entire United States were investor purchases, according to Redfin.com. And so this is up from 16% in 2019. So you're seeing an increase in the type of buyer, according to Redfin, from 16% to 20%. That's nationwide. But he's got a lot of homes with us here in Jacksonville. And if you look at Jacksonville, the percentage actually has gone up a lot more. So the percentage of investor purchases in Q1 of 2022 is 32%. And that's up from 20% in 2019. So Michael's saying, hey, listen, it's great that people are buying in Jacksonville, investors are buying in Jacksonville, but what happens on the flip side? If the market should crash, which I don't think it's going to, but if it should, would this contribute to a crash? Could I be in a place where my investments are not worth what they're worth today because of this phenomenon? So a couple things to clarify. I dove into the data. According to Redfin, an investor purchase is just simply the entity that purchased it. So there are a ton of individual investors who happen to buy in a company name. Okay. So that would lead to this 32% number in Jacksonville. It is a lot of individual investors buying in a company name, which is important to note. Here's another thing. I think all of us are kind of lumping in this like Wall Street buying idea, and there is a lot of animosity of Wall Street coming in and buying anything, but it happens to be a lot of single family rentals. And when you think of like Wall Street buying a bunch of single family rentals and you hear that 32% of purchases are investor purchases, we tend to think that a third of the homes that are purchased are by Wall Street. Well, I dug more into the data, and that's actually not the case. According to John Burns, roughly 3% of the homes in the entire United States that are single family rental properties are owned by institutions or Wall Street investors. These would be, they classified as anybody any institution that owns over 1,000 properties. Just 3% are owned by Wall Street. This 32% that you're hearing, again, is a lot of individual decisions that are made in a company name, or they are smaller real estate investment firms. JWB would be one of those smaller real estate investment firms. Of course, we buy that in a company name, but we are not Wall Street, right? And so I think it's important to kind of differentiate that. I threw out a lot of numbers there, Pablo. How's that all landing for you?
Yeah, I like that you clarify data locally, right? Like I think we're so headline driven and we hear these like audacious numbers. And to me, it's very clear that folks that are part of our community that tune in on the show really value the feedback of boots on the ground, like the market insider information that you have to offer. As you are delineating these numbers, what first comes to mind for me is, okay, cool. So, it's not Wall Street, so I can detach the emotion of ivory tower, investment with no emotion and no tie into the community from what this represents. And as I hear the rest of it, it sounds like more people like us are flooding to this asset class the same way that we're doing it. Still doesn't change the idea that what is the effect of people buying homes that don't plan to live in them going up in percentage of homes owned inside of a market versus the people that plan to live in a home, owning them, being the dominant percentage, right? So I would love to address that piece and how you think of this idea of whether it's Wall Street or not, there still seems to be an uptick in investor ownership versus homeowner ownership in Jacksonville. What do you think that means for investors?
That's a great way to put it, right? There's a couple of different ways that we're going to go about answering this question. Is it good or bad? Still is out there, but at least we're identifying that it is thousands of individual investors making a decision on thousands of properties rather than one or two or five people sitting in an ivory tower in Wall Street affecting tens of thousands of properties. That's not what's happening across the country. Even though you are seeing Wall Street get more and more involved in that. But your question is still there, and Michael's question is still there.
Yeah, and I guess if what I'm hearing then from what you're saying, then I guess it's like, okay, it is not the same risk of, we talk about diversification as investors, right? So like diversification of investors is probably a solid thing for a market as opposed to just like one or two or three players controlling the whole thing. Is that kind of what we take away from the difference in those statistics?
Yes, exactly.
Okay.
If your fear is that all of a sudden somebody's going to make a decision that this investment is not worth it for them anymore, and they're going to start selling their properties en masse, and that's going to crash the market, you would have less risk if there are thousands of people making that decision versus just one person. And so it gives a little bit more context that it's not just that one person or five people, and so that limits the risk, just like you said.
Cool. Okay. Continue.
Yeah. So, but the question still remains, there is more investor activity, even though it is spread across thousands of decisions here in Jacksonville and across the country. Is that a good thing or a bad thing? I think for this question, we have to look at why are those investors making those decisions? Because if I put myself in Michael's shoes or in anybody's shoes that was investing before the Great Recession, we understand that if there's a lot of investor activity and they are speculating and they are hoping that prices go up, and then all of a sudden they don't go up, those thousands of people all still could make that decision to sell and potentially drop the market. So I think we have to understand, why are they making the decisions? Why are the investors making the decisions to buy at a really high clip in Q1 of 2022? And so I dug into the data again. In 2001 to 2006, which was the run up before the Great Recession, people were buying for a very different reason. People were buying hopefully low and expecting to sell high, and they were expecting to do it in a very short time period. And there's a lot of reasons behind why that became possible. But at the end of the day, you had an entire nation of real estate speculators. You had people that the most important part of the decision for them was short-term pricing. And when the rug was pulled out and the lights were turned off at the bar at the end of the night, and everybody understood that the real estate world and the lending world contributed to the massive gains in home prices and that the music had to stop, those same people that were basing their investment strategy on short-term pricing and speculating at that point They didn't have 5 profit centers. They didn't have an asset that could pay for themselves every single month. And they had acquired 5 or 10 of them. And then all of a sudden they couldn't afford the payments. And then they sold those houses en masse. And that contributed to the collapse and the great recession that we all experienced. So that's why they were buying then. That is not why investors are buying now. I looked up one data point that I think tells a very telling story, right? The average 30-year interest rate in January of 2005, which was like the height of the party as far as speculating in 2005, the average 30-year interest rate across the country was 5.77%. So that's low, but not crazy low. And when home prices spiked like they did, those 5.77% interest rates could not support cash flow positive investments at that time. And that's why people were speculating, right? Home prices went way up, call it 5.77% interest rates. You didn't produce a lot of positive cash flow in a lot of markets out there. So they were speculating. So 5.77% was January 2005 average interest rates. Pablo, you want to take a guess of what the average interest rates were in January of 2022?
Like 4.5?
2.65%.
I was way off.
You were way off, right? 2.65%, the lowest that they have been in history, okay? When you have the opportunity to borrow debt for 30 years at 2.65%, you are going to make moves to take advantage of that if you're a not your average investor, right? Even if you're not a not, if you're an average investor, you're going to take advantage of 2.65% interest rates, right? And so that is the reason why there's so much activity in Q1 of 2022. And you ask, why are those people buying? Are they speculating? Is short-term pricing the most important thing to those people? No, they're buying these assets because of all 5 profit centers, right? They're buying the way that we all think about it as a part of the Not Your Average Investor Show community. And short-term pricing for us is the least most important part of the decision. If you have the ability to lock up debt for 2.65% interest rates, like we all had the opportunity to do in January of this year, you buy that. And the last thing you want to do is sell it in 6 months or in a year, right? For all of us who are able to lock up debt anywhere around that 3%, even 4%, even 5%, right? That low cost of debt will make you so much more money the longer you hold on to it. So what you're seeing is we are not a nation of speculators at this moment, nearly to the degree that we were in 2001 to 2006, because all 5 profit centers are working for us now because interest rates were so low. How's that land?
Yeah, it lands for me, right? Like, I think if I was to simplify all the stuff that you said, you are essentially stating that right now, you know, the first time that people started running in mass towards real estate, it was a short-term play with a different risk proposition. And now where that money is going, where these headlines are coming from, are going into a more mitigated risk asset class that attracted long-term investors, because what is attractive is the long-term leverage that they can get on their money, or else they would have probably been putting it in something else. So this is a different breed of investor with a different timeline and a different propensity for risk that are making these headlines. Is that kind of what you're saying?
Yeah. And the thought would be that even if prices level out next year, even if prices would decline next year, right? The investors who are making decisions today or in Q1 of 2022 are going to be much more likely to hold on, especially if they understand that real estate is cyclical and home prices would eventually, rebound, which they did in the Great Recession. People have been seeing that. So those same investors who are making that decision today are not nearly as scared as the bottom falling out of prices without an eventual rebound coming. So
So it sounds like right now what you are, when you get this question and you're answering, you're getting the sense that people are asking from the sense of, will the bottom, is this an indicator that the bottom can fall out, is kind of what you're answering towards. And it's a resounding no, because the folks that are buying this were buying this kind of like you did in 2006 in the minority. You were buying an asset class before a crash, not really knowing like, like how awesome it was going to be during the crash. The people that took this action, that have created this data point, are taking it based on the assumption that this will perform well if there is a crash. Ergo, they will not sell during a crash and run out short-sightedly, right? So like, you are right now talking about the floor not coming down, right? Like it is a high floor on this, and this data point makes an argument for the high floor of the asset class. Is there also an argument to be made that this increases the ceiling of the asset class, right? Because when I hear Wall Street is doing this, or like investors are all running to this, my mind as a person who comes from a city that was built for outside investors, Miami, has always felt like I am behind on the ability to like get in on a price point that continues to like outpace my reach. Right. So like that's what I've seen happen when a lot of investors flood into the market from elsewhere. It's kind of what Barbara Mershon is saying, that she saw the impact of purchase prices not mattering to buyers when it all skyrocketed in Denver after the marijuana cash flooded in the market there. Right. So like, to me, as an investor that's already in this asset class, I see it as all this money came in. This creates a buoyant force on demand. Well, it creates a buoyant force on price because supply is greatly reduced, and that's not going to change hands if they're going to be there a long time. So now whatever inventory comes to the market the prices are going to continue to go up because of this increased investor demand. And it's also going to make it so that people that live there are less likely to buy a property themselves and more likely to rent, therefore still reinforcing the asset class if these prices are going to go up for residents. Am I going too far down the line here? Because that's where my head went when somebody brought this up.
I mean, you bring up a lot of different points there. Let's break them down. Please. One by one. All right. The first question I heard from you was, this is going to have a higher floor? Is this also going to have a higher ceiling? And if we're talking about the investor coming in and buying, whether that is Wall Street or whether that's, investors just like us, is that going to have a higher ceiling? I think this has much more of an impact on a higher floor for this investor activity than I do for a higher ceiling. Because if you think about it, investors make decisions based on returns on investment. And I'll give you some other stats that show this increase in demand and why this will increase the higher floor for all of us. Wall Street is coming in big now, and it's very recent, but Wall Street, this is the beginning of this asset class, meaning single family rentals, becoming institutionalized. That means that Wall Street money, private equity, hedge funds are buying single family properties with the intention of holding on to them and creating an asset class that their investors invest in. Like, this is the first time really over the last few years that this has ever happened. This isn't the only time it's happened in real estate, though. This is how commercial properties, this is how apartment buildings, these other asset classes have already become institutionalized. And it's very normal, right? So we know how this works. In single family rental properties, in the year 2020, there was $3 billion of Wall Street money that came into this asset class. $3 billion. That, I don't know what it was before that. Was this the first year John Burns started tracking it? It was probably like close to zero. I mean, it just didn't happen before. In the year 2021, that $3 billion went up to $45 billion in the year 2021 of Wall Street money, institutional money coming into this asset class. And in the year 2022, we're not done yet, but we're up to $50 billion of Wall Street money coming in here. Okay. And that's only 3% of the assets of the entire country, single family rental properties that are owned by institutions. So there is a lot more runway to go here. I expect that 3% number to go up. just like it has for apartments and commercial properties in the past. But here's the thing, those investors, those institutions make decisions based on a return on investment. So when prices go too low, Pablo, what do you think the returns do for those institutional asset classes for new purchases? If prices come down, what are they looking at?
Higher returns?
Yeah. If prices go so far down that the returns increase, what do you think institutions are going to do?
Buy more.
Buy more. That creates a floor for pricing. And that's $50 billion of demand that wasn't there in 2008 when we had the Great Recession. So the floor concept plays a lot more as the higher floor here because of the institutional impact that we see today and will see in the future. Now, the higher ceiling is more of homeowners just like us, right? If you take your investor hat on, you put your primary homeowner hat on, I buy my personal house not based on the return on investment. I buy it where I want to live and what makes my family happy and all that good stuff, right? And I'm willing to pay a lot more than what would possibly cash flow because I value that. And so the ceiling for our asset class is much more determined by individual homeowners paying what they want to pay for the place they want to live. And so, affordability actually is the greatest indicator of ceiling or a cap on a ceiling for our asset class, which is why if you think about some of the things that JWB does, we're focused not just on the problems of today, which are buying assets and renting them for you all and doing great property management. We're also focused on how to increase median incomes in Jacksonville, because I know when I control your money for the next 10 or 20 years, I need median incomes to rise in order for you not to have a cap on your returns on investment.
Got it. Okay. So then that takes me to like a couple of these Q&As. So I get what you're saying, right? To me, it's the ceiling, the home ownership, the local home ownership part is a different part of the equation that has much more to do with rising income levels. The floor is great with, Wall Street coming in. I'm also getting the sense that this is going to be harder and harder for the average, not your average investor to this is a moment right now where everybody here in this chat that has invested and is investing is standing side by side with Wall Street giants, putting our money in the same place, kind of like before IPOs got impossible to invest in, right? Like if the average American used to be able to invest in IPOs in a much more democratic fashion, we're now in that democratic state of like affordability for a single investor getting in on this like asset class that's rapidly becoming for the big boys. And that seems unique. As far as the median income levels, right? So there's a couple questions here that have to do with that. Chris Gonzaga asks and I'm not sure if you can answer this or how you would answer this, but if JWB was able to be part of Wall Street, would they partake? Is that a clear question for you?
I'm wondering how exactly what he means if we were able to partake or if we were able to be a part of Wall Street. I'll answer it a couple of different ways. We love serving everyday investors. We relate to everyday investors. We feel like we think like everyday investors. We are everyday people. My team is really valuable. And everyday investors value the team and they value the experience. And so we're built to serve the everyday investor. Wall Street's not built that way. Wall Street does not value the experience nearly as much as our clients do. And so there's not really a fit for us to work with Wall Street. How do I know this? Because we've had funds that have approached us wanting to buy tens, hundreds of homes at a time. And the easiest way for them to understand, or for us to understand that it's not a fit, is that they want a discount off of market value to buy the properties. And for us, there's no discount off of market value because we sell the experience. People come in paying exactly what the market value of a home is, and we give them the very best experience. And when you look at the returns on investment along with the experience, it's probably better than what you're getting in the stock market. So Wall Street doesn't think that way. So we have not built our business to serve Wall Street. At the same time, there have been funds that have come in, and because of the value of the assets, they've wanted to pay market value, and then we'll sell some homes here and there to funds. But I mean, it's such a low percentage of our sales. I mean, in our history, it's probably less than 3% of properties that we've sold have been to Wall Street or private equity type of funds.
Yeah, that makes a lot of sense. First of all, Chris says that's the answer he was looking for. Thanks, Greg. To me, it makes sense, right? Like I'm at this like small private equity conference right now. It seems to me like that these like deal junkie guys that are looking for these types of things and fancy themselves the smartest guy in the room are always looking for like an extra edge. So you've kind of built the retail experience for the average investor, and people that operate on that level, they're looking for the 5 profit centers and they're looking for an extra profit center, which is like advantage in acquisition, which is not something that you sell. You sell convenience and not having to build that machine that sources this stuff. So I think it falls naturally to me based on who that person is having that conversation with you versus what you sell.
Yep, exactly.
Cool. Awesome, man. All right. So Kurt Stein's got a tougher question, right? So Kurt, he cares deeply about the economic development of Jacksonville, and he's like us trying to work to make this place better. And he's asking, it seems like outside investors would remove money from the local economy. Rent payments going to Wall Street versus local investors. Insurance payments no longer going to local insurance agents and carriers. Less business for local home inspectors, less business for local mortgage companies. I certainly don't think it's great for the local economy. Any thoughts?
Kurt, love seeing you here, buddy, by the way. Thanks for being here, man. I think you bring up some good points, right? This question of, is it good or bad that Wall Street is buying more homes today than they were in the past is not a single answer. There are positive aspects to it and there are negative aspects to it, right? So if Wall Street comes in and buys a lot of homes, which they are buying more today, and looking at the opportunity for the institutional asset class to grow, I expect them to be buying more in future years, right? Some of the money that was here in this local economy is not going to stay here, right? And I think that's very real. However, on the other side, there are other advantages to institutions coming into an asset class and, having a big presence like they are here in Jacksonville. Some of the institutions that come in bring a different mindset. Let's talk about property management specifically, right? For all of us, I mean, we're affected either by, home prices or property management because we'll rent, right? On the home prices side, the fact that Wall Street comes in and provides much more of a floor to pricing, I think we can all relate to that being a good thing, because we all experienced not having a floor and not having $50 billion of demand in 2008. So there's certainly a good thing there. On the property management side, it's like a different breed of property management mindset today than there was 5 years ago or 10 years ago, right? I mean, I think we have thought this way here at JWB since our inception, but now I get into circles now, and there are entire conferences of people that are using systems, technology, data flywheels to better manage properties. And that's just not the way it was done. I mean, you think about JWB, we implemented self-assisted showings in 2020, and that was revolutionary. The fact that people could actually go and see homes for themselves and rent a home without, the normal way of doing things from a property management perspective. You used to, and you still call it property managers, and they drive 45 minutes to go and meet you at a house. It's just an inefficient process. So, I just think that there are different points to this answer. Kurt, you're right. Some of the money that would have stayed local is going somewhere else. But there are other advantages here. And, where this is all going, guys, is this is actually democratizing the single family rental space. So I know right now we think of like us putting in offers compared to Wall Street putting in offers and us getting bullied by the man, right? Us getting, not having a chance to buy the property that we want. Ultimately, this is going very much where apartments and commercial investments and REITs have been for a long time, right? You're going to have the ability to invest in single family homes at some point in the future. And you do today if you invest in some of these single family home REITs. But you're going to have much more opportunities to invest in single family homes and putting a small down payment down, or a small percentage of what you would have paid now. It's just going to be in the form of investing in a fund, or investing in a REIT, or investing in some type of institutional asset class. You can do that today. It's just going to become much more normal for single family ownership as this becomes more and more of an institutionalized asset class. So I even think like the fact that Wall Street is coming in and maybe bullying us and maybe taking money away from us, I think that is probably more what we feel today. But in 10 years, I think that while that will happen, it will also create other opportunities for singular investors like us all.
Yeah, and if I'm thinking of it from Kurt's lens, right? Like Kurt has a home inspections company. He's a local business owner, and he's trying to figure out, what this means for local business owners. It sounds to me that with more sophisticated money coming in, there is going to be a higher level of expectance from local business owners. Therefore, our market will mature to have better services because the demand from the outside is going to require it and or bring people in that can do it, right? So like it feels like a chance for the local economy to level up to a certain extent and operate in a modern fashion, make this asset class be more reliable, a better experience, right? Like the idea that right now at this holding company conference, I'm here, people still associate single family home real estate investing with like a terrible experience that you have to like go through all these horrible things. That's going to start to go away as, people are demanding higher level of performance. And then that makes it so that at some point there's going to be a Robinhood app that I can pick up shares in a group of single family homes like what JWB has. And I don't need to come up with a $60,000 down payment. It might be like a $5,000 investment, which I think it's good. As far as local economy and services, when I hear Kurt's question, he's asking, I still think that it's really hard to take money out of the local economy in the home services sector for the time being, right? Like whether or not those profits are going to roll up to a holding company that's like vertically integrating them or whatever, it's still going to be like nobody's going to move here from Wall Street to do the home inspection. That person is still going to have a job under you, and that person's still going to need a local production manager that's there. And Whitney Ritchie and her like moat that she has by knowing everybody in town and selling insurance is still going to be the person selling you insurance, even if Lemonade is creating this like new kind of like category design around like buying insurance really easily, right? Like I still think that the local business in this this asset class of construction and home residency is money that's going to stay in the local economy much longer than many other sectors. And then to boot, the fact that in Jacksonville specifically, JWB, who has this mentality and is local and thinks long term, is going to continue to like champion that stuff. I think it bodes well for Jacksonville and local businesses, right? Like it doesn't seem to me like a mass exodus of local money.
I mean, I think I'm really glad you brought that up because I was thinking more of like rent payments going to Wall Street versus staying here locally, which that would be money going there. But Wall Street still knows that real estate is hyper local, and having a team on the ground is the only way that the Wall Street guy or girl in their office making the decisions is going to be successful if they have boots on the ground. So with Kurt's company, his home inspection company, I think that this is an opportunity for you all to really grow your business. It's an opportunity to run more efficiently. And I think there's a lot of value there. So home inspectors, right? I mean, there are entire investor groups that basically buy for these Wall Street companies in Jacksonville and in every part of the country, right? And so Wall Street doesn't just make the decision based on numbers. They work with an outfit, maybe similar to JWB, but we don't do it. And that is their buying arm in all of these markets. So your real estate agents who are working for these Wall Street firms, home inspections, I think insurance is a huge opportunity. I've been working with a couple of funds right now, just talking to them. And I'm like, listen, the insurance rates that you're getting quoted to you from your national providers are like 3 times as much as what we get here for the same product when I work with the Whitney Ritchie group. And so I'm putting Whitney in touch with some of these connections that we have to try to help out all parties. And these Wall Street type buyers, they really appreciate that. So I think it still remains to be seen that the cream will rise to top, was it cream to the top, cream of the crop? I don't know. What is it? I can never remember what these are.
The cream will rise to the crop. I think you got that. That sounds right, right? Yeah. The cream rises to the top.
Cream's going to do something.
It's physics. It's physics. Cream is less dense than the hard liquid, so it rises to the top.
There we go. What he said. It's going to be an opportunity for those businesses that are, home inspection companies, boots on the ground. If you can work with some of these companies, I think it's going to be a much more profitable way for those individual businesses as well.
Makes sense, man. Let's touch on a couple more things on this one because we got some Q&A, and then let's move on to the other bullet point, because I think this bullet point, this was massive. Obviously, by the numbers of folks that showed up, this is a conversation everybody wants to have. They love doing this. Keep submitting amazing questions. Who was it that submitted this question?
Michael Santorios.
Yeah, Santorios gets the MVP of the day right now, because this has been a great conversation. So Bob Wiesner has a question. He asks, how does Jax compare to other cities in the USA on the percentage of owner-occupied versus tenant-occupied housing units? Is there any data there that you're familiar with?
I don't have the data right in front of me, but you know what? I think that's a good thing for me to write down and get back to you guys on a future show for.
Let's go. Perfect. All right. I'll put that in the old Google, Apple Notes that we follow this thing with. All right. Miguel Angel has a question. Construction of single family homes, has it increased or decreased against March 2020 pre-COVID? Is it construction going up? Increased
dramatically. I'm speaking about JWB and, Jacksonville overall and across the country. There is a huge lack of supply in the housing market, which has contributed to rising home prices. And at the same time, interest rates were so low for so long, like we were talking about. And so this huge demand for housing, basically gave builders a huge incentive to get building done as quickly as possible. So JWB went from probably 300 homes built in 2019 to 600 this year. And if we could have built 800, we would have. So everybody is trying to build as much as possible. And the only problem is it takes a lot longer to build today, and it's much more expensive today than it was in the past.
Yeah. So that's housing supply. What about people supply? Eddie Harris is asking, how well is the population expanding in Jacksonville? More people equals more housing demand. What do you know about population growth?
Man, Eddie from Hotlanta, man, great question, because you brought up an idea that I had related to Kurt's question as well, is that like, if you're a business provider, right, you might be looking at Wall Street coming in, maybe taking some money out of the local economy. But the bigger thing is like, look at the population growth. That's an area that I want to be a service provider. So I think there's a lot of really wonderful things to look at for the Jacksonville economy here. Eddie, the population is expanding. The latest data that we have from the US Census was from 2017 to 2019. Jacksonville was the 5th fastest growing metropolitan statistical area, which is an MSA, the 5th fastest growing MSA in the entire country. And that was 2017 to 2019 before the pandemic. If you look at all the lists since then, which are like U-Haul talking about moves to Jacksonville versus other places in the country, or LinkedIn changing like where you're from like Sheboygan to Jacksonville, they all have Jacksonville in one of the top 5 cities that has grown because of the pandemic. And so we would expect those numbers to be even better as some of the census data on population growth comes out. So this, at the core of it, is something that drives home price appreciation and drives rent price appreciation over long cycles. And when you're all buying rental properties like you are, and you're buying and holding for a full market cycle for all 5 profit centers, being in a growing population is one of the most important decisions you can make. And that's what Jacksonville is.
Awesome. And Eddie is asking, any co-MVP votes? I don't know, Eddie, but you get an honorable mention. How about that, buddy? That's a great question. All right. So let's move on. We got another maybe 10 minutes, GC. The other thing I really wanted to get into is MOI. We talk about it all the time. Months of inventory, headlines all over the place talking about how months of inventory is jumping big time, and that should scare the hell out of all of us. What do you think about that?
Well, you can talk out of both sides of your mouth here. I think that's what I guess I'm just going to share both sides of the story here. I feel like there is a lot of negative headlines out there that freak people out. And when you look at the actual data behind it, you become less freaked out. And so I feel like the media is largely doing what they are doing in order to get clicks and in order to get views. And, so I'm going to try to share some of the actual data with you and also be a little forward looking, because guess what? The real estate market is changing, right? We needed it to change. I looked at this year. Do you know that we've had 25% home price appreciation this year? Like last year, it was 20%.
I did not. Are you serious?
Yeah.
Even with the interest rates and everything?
Yeah. Yeah.
Well,
We've had 25% home price appreciation here in Jacksonville this year. Last year, it was 20%. It was close to that the year before. Like,
that's exciting.
Yeah, we have all on the show talked about how like it's probably a good thing that homes don't appreciate at 20% or 25%. For me, as an owner of JWB, and the largest portion of our income comes from home sales, I would love it if home price appreciation would just stay steady at like 4.5% a year over year. Like I would love it if we didn't go 25%, right? Because then that freaks people out about there potentially being a crash on the other side. If you look at how real estate pricing actually works over the long haul, there is a very, very small number of years that home prices have actually declined. It is not normal, but it raises that perception of people that they think it should happen. Here's the real data. The best short-term indicator of pricing is called months of inventory, MOI. If you're a fan of the show, we talk about it often. It just simply is how many homes are on the market versus how many sold the month prior. And what it tells you is the number of months it would take to exhaust the current inventory on the market. If you look over history, if you have between 6 to 7 months of inventory, that would equate to the average appreciation for your area per year. And in Jacksonville, that number is 4.6% per year. So all of that means once we get to 6 to 7 months of inventory, that would indicate that we would only have 4.6% appreciation per year, okay? Now, we've been tracking MOI every single month since 2014. Every single month we track this. I had never seen it below 3 months of inventory ever. It started to go below 3 months of inventory like 2 years ago, which is why on the show we talked about how home prices were going to go up and why this was an incredible time to buy, because we expected home prices to go up significantly. We were seeing MOI at levels of like 2.5 or 2. Well, here's where we are right now. We are at 1.88 months of inventory in July here in Jacksonville. 1.88 months. That is experiencing a very low supply of homes. We do not have enough homes to support the demand that we currently have. Now, if the media is saying that home prices are going to go down because sales have slowed dramatically, right? Sure, right? MOI has risen from 0.96 months of inventory in April to 1.88 months in July. So we are starting to see MOI tick up, which is exactly what we have been expecting. Nothing is happening out of the ordinary here. We would expect MOI to continue to go up, and it will normalize, right? It will get to 6 to 7 months of inventory, but it ain't happening now. And it takes a little bit of time for that to happen. So here's another thing to put it in perspective. July of 2020, 2 years ago, we were at 2.35 months of inventory in July of 2020. We are at 1.88 now. So now, to be fair, this is going to go up, whereas in July of 2020, I didn't know if it could go down any longer, but I knew it wasn't going to go up. Now, I expect it to trend positive, and you all should too. But just keep in mind that 2 months of inventory, 3 months of inventory, 6 months of inventory, 7 months of inventory doesn't mean crash. Historically, that has meant normal home price appreciation. So we got a long way to go. I'm excited to keep you all updated on this, but I just want people to look beyond the headline. Like, here's a headline. This is from a Fortune article that was just sent to me. The article says, across the nation, home sales are plummeting and inventory levels are soaring. Fortune magazine. Across the nation, home sales are plummeting and inventory levels are soaring. I just told you, we're at 1.88 months of inventory in Jacksonville, which is one of the hottest markets out there to invest in. So clearly that's not accurate. The same article says, here's another good one. It says, Moody's Analytics chief economist tells Fortune, we've gone from a housing boom into a full-blown housing correction. And we will... And so then I thought about that. And I'm like, Pablo, I go on these rants every once in a while about how terminology in real estate is not held to the same standard as terminology in the stock market. Well, in the stock market, Pablo, a correction in the stock market means that that the prices for the S&P have fallen between 10 to 20%. That's when we start using the word correction. Yet here, this article says we have gone from a housing boom to not just a housing correction, a full-blown housing correction. Here's the rest of the statement, though. This is from the chief economist. He says, we will soon see year-over-year home price growth fall from a record of 20.6% to 0%. So this full-blown housing correction, all he's saying is that home prices might be flat next year. Like, do you think that that's maybe different than how that article reads?
Yeah, no, that's as a marketer and somebody who understands copyright and understands the human brain, I know that they are trying to draw attention with language that they're allowed to use, but isn't necessarily, accurate to ethical and in some regard, right? Like using the term correction makes you think, oh my God, 20% correction like a stock market. But, like you said, they don't hold it to the same standard for real estate. And what I'm hearing from what you're saying is, even if at some point we are headed towards a stabilized market with historically normalized home price appreciation of 4%, which would be somewhere in that 7 months of inventory, what the housing market did when MOI was higher than this to now was a pretty attractive scenario, right? So like if I'm thinking about investing, I wanna get in on the side where I'm still receiving this upside and baking in this like higher appreciation now, so that then it can make up for the slowdown later and then catch back up, right? Like you kind of described the short-term appreciation, the short-term MOI numbers as like, baking in upside as opposed to like buying and then having to catch that upside later, no?
Well, let me scale you back a little bit here. Here's what I think, right? If we go back a year or two ago, it was really hard for me to get off of the talk track of like, buy for the long run. Short-term pricing is the least most important thing. Like, it took me a long time and I finally caved and I was like, guys, listen, home prices are lower today than they're going to be in the future. And you know what? It's probably a lot lower today than they're going to be in the future. And at the same time, interest rates are so low right now that like literally, guys, you should buy right now because you're going to start banking appreciation, because appreciation is going to happen. I mean, that's really what we've said on the show for the last 2 years. We've helped a lot of clients buy because of that. Pablo, you've got 3 homes now and you've been able to, and you've benefited from that. What I'm excited about now is that we're going to go back to the normal way to buy rental properties, which is, why are we paying attention to short-term pricing? You buy for the long haul. When you buy for the long haul, you benefit from all 5 profit centers. And the reason you need to buy for the long haul is because when you invest for the long haul, you can count on home price appreciation, but you can't count on it next year or the year after. You count on it when you hold for 10 to 20 year cycles. So buy and hold for the long haul, expect about 4.5% appreciation year over year on average when you hold for such a long time. We're going to get back to basics here. And I'm really excited about that. So I think, and I know that short-term pricing is the least most important part of the decision. I hope everybody really takes that to heart right now, because if you do that, you're going to buy turnkey rental properties and you're going to make better decisions than what your alternatives would be. Because if you look at other places to put your money right now, they don't look so great, especially heading into a recession, right? Short-term pricing is the least most important thing when it comes to rental properties. Long-term, this asset class still kicks butt. It kicks butt compared to the other asset classes, as long as you can find a team that makes this a great experience. You know any teams like that, Pablo?
Yeah, I know at least one really, really good team like that, that I've been getting a great experience with, man. This was awesome, man. Had 50 plus people. We were close to 60 at one point, right? Like, I feel like we went, little peek behind the curtain here, fam. Like, there was about a month ago when we're like, what's going on? Why are we only getting like 25, 30 people? Like, where's our community? And you have all come back in force. You have all absolutely re-engaged with the things that we're talking about right now. That's a really great quality, really great qualitative, like data point for us that we are bringing value. And the fact that you're engaging and you're providing the topics and we're hitting these topics and people are showing up for it. You know what I call that? I call that a flywheel of a good experience, because we want to talk about what you're interested in, what is concerning you, what you're trying to learn about. And I love this feedback mechanism. I love this format of, bringing up topics and you ranting about it and me asking you questions and coming up with my own harebrained things. And then you cooling me down a little bit, and great folks like Kurt Stein showing up. And, like this is awesome, man. Like, this has been a really, really great show. I really just appreciate the community and those of you that take an hour out of the middle of your day to be here and really carry this for us and like push this forward. It just never goes without noticing. If you're listening on the podcast, you're listening on YouTube, you're really missing out on a true like community experience of like being part of this content creation and being part of the educational cycle of all of us. So go to nyais.com and join us. Thursday, we're back with the JWB of the week.
Week.
And we got we got kind of a legend around here. We got Dean Curry coming on, man. He's right down the street from me right now in Ohio. So
That's right.
That's right. I'm in Cleveland right now. So just got to go down to Columbus. But super pumped to talk to Dean. Met him at the IRL meetup recently. So really, sophisticated, educated real estate investor, excited to get into his journey. And GC, I'm glad to have you back, buddy.
Hey, man, I love the vacation that I got to spend with my family. It was a truly incredible time, but it is so nice coming back to your job and coming here and just like getting uplifted by the hour that we get to spend together with our community. It really has a dramatic impact on me to see 60 plus people showing up and to see the great questions and, hundreds of chats going on. I can't even keep up to see my mom show up for the call. Like, these are all just really wonderful things that make an impact on me. And I just wanted to say thank you to you all for making this thing real. We're excited about, where we're taking the show, and we're excited to have you all here to make it super special. So I'm excited. We'll see you on Thursday.
All right. Stay excited till Thursday and stay not being average. See you soon.